Right now, the entire financial world is staring directly at the artificial intelligence boom, completely convinced the stock market can only go up. But deep inside the debt markets, where retail investors rarely look, a very specific warning light just started flashing. The last time this exact pattern appeared was exactly 6 months before the 2008 financial crisis, and almost everyone on Wall Street completely missed it. This line chart tracks what's known as the credit spread. In a rational economy, lenders charge high interest rates to risky, struggling companies and lower rates to stable, safe companies. The difference between those two rates is the spread. It's your financial reward for taking on extra risk. But right now, that gap has collapsed to near zero. The market is lending money to companies on the edge of bankruptcy at almost the exact same rate they charge healthy businesses. When we expand the timeline back, the data shows exactly what this means. Investors are so desperate for any kind of yield that they are taking on enormous default risks and demanding zero compensation for it. The last time we saw investor desperation compress spreads to this exact level was the spring of 2007, precisely 6 months before the collapse of Bear Stearns began. This creates a massive, invisible feedback loop. Because lenders are ignoring risk, heavily indebted zombie companies, businesses that do not make enough profit to even cover their interest payments, can easily roll over their debt at low rates. They stay alive, they keep spending, and they artificially inflate the employment and earnings numbers. The economic strength you see reported on the news is largely a mirage. The current record highs in the stock market are sitting directly on top of a fragile, highly pressurized credit bubble. And mathematically, a credit market completely devoid of risk premium always snaps. To understand how to position your portfolio for the snap, we need to look at this diagram. It plots the 4 rigid phases of every market cycle: accumulation, momentum, euphoria, and reversal. The crowded tech trades driving the current indexes, the massive semiconductor and AI valuations, are sitting right here, squarely at the peak of the euphoria phase. Generational wealth isn't built by buying a great asset and holding it blindly through a crash. It is built by identifying when an asset class has entered peak euphoria, taking your profits, and rotating that capital into the next cycle. Institutional smart money is already executing this strategy. While retail investors continue to bid up crowded tech stocks, major institutions are quietly deploying capital into ignored, out-of-favor sectors that are currently sitting in the Phase 1 accumulation zone. Protecting your wealth requires leaving the crowded tech trade behind. You have to move your capital into the next cycle voluntarily before the credit market inevitably breaks and forces the rest of the public into a chaotic, panicked exit. Right now, the market is pricing AI and semiconductor companies as if they will grow infinitely, with revenue multiples currently matching the peak of the 2000 dot-com bubble. Investors are treating this technology like an unstoppable digital force, but artificial intelligence has a critical vulnerability that the software booms of the past did not. It is entirely tethered to the physical world. AI does not exist in the cloud. It lives on heavy iron. Every query and generation requires thousands of physical servers packed inside massive, highly cooled data centers. Those digital growth projections are hitting a physical bottleneck. You cannot build a data center without vast tracts of land, thousands of miles of copper wiring, and staggering amounts of electricity. The software revolution is effectively stalled until the physical world can catch up. The infinite demand for compute power has finally collided with the hard limits of physical scarcity. This scarcity triggers a severe macroeconomic shift. We are leaving the era of low-inflation digital growth and entering an environment driven by physical material deficits. When you have infinite demand chasing a restricted supply of copper, steel, and power, structural inflation stays sticky and elevated. That persistent inflation acts as a primary catalyst that breaks the zombie companies. As costs rise and rates stay sticky, debt becomes too expensive to roll over. The companies at the edge of bankruptcy eventually fail. The bank lending stops, and that collapsed credit spread we saw earlier explodes outward. When the credit markets freeze, companies can no longer borrow to fund their operations. They execute aggressive layoffs and slash spending. This flows directly into the equity markets, pressuring high-flying tech multiples as corporate earnings fall. Capital will likely flee those tech equities and seek safety in the assets that maintain real value during physical shortages. The tension between AI demand and physical supply creates the conditions for a credit event that forces a massive rotation of wealth. To survive and profit from this rotation, you need to identify the physical sectors sitting in the accumulation phase today. The first sector is commodities. The global AI grid requires millions of tons of copper and raw materials, but developing a new extraction site takes decades to permit and build. We are staring down a 10 to 15-year structural deficit in the materials tech companies desperately need. The second sector is energy and electricity. The power draw from modern data centers is so immense that local power grids are already buckling. This demand forces traditional, slow-yielding utility companies to reinvent themselves, turning once stable dividend payers into growth-oriented tech proxies. The third sector is infrastructure. You cannot deliver that new electricity without physically modernizing a grid that was built in the mid-20th century. The companies contracted to lay the cable and build the substations are currently trading at significant discounts relative to their future cash flows. The data indicates that the industrial titans, the massive companies physically digging the mines and building the grids, are the businesses positioned to absorb the capital currently looking for an exit from the digital software sector. Recognizing the shift is the first step, but executing the trades requires precision. That is why we developed the Bravos Macro Report, a detailed analysis designed to help you track these specific credit and commodity conditions. Inside, you get immediate access to the 6 specific accumulation phase stocks we are targeting in the commodities and infrastructure sectors. You also receive our proprietary financial models and regular updates as these credit conditions continue to evolve. This level of institutional data is usually priced around $2,000 a year. We've shifted our model to offer this report to retail investors for a single payment of $199. And it comes with a 30-day, 100% money-back guarantee. If the data doesn't help you prepare, you don't pay for it. Click the link in the description right now to secure your portfolio and get the Bravos Macro Report. Make sure to hit the subscribe button so you do not miss our next market warning. While the 2007 signal gave investors several months of lead time, that window exists for active preparation. You can stay in the crowded tech trade and hope the credit market holds. Or you can begin rotating into the physical assets that are entering their own bull market. The choice is yours. I'll see you in the next one.